At the start of 2025, the White House sent Canada into a frenzy with a shocking announcement. President Donald Trump planned to hit Canadian imports with a steep 25% tariff. The official explanation? Concerns over border security, illegal immigration, and drug smuggling. The news spread like wildfire, triggering an immediate uproar across Canada. Government officials, business leaders, and everyday citizens found themselves asking the same question: how should Canada respond? Some pushed for tough retaliation, arguing that Canada shouldn't sit back while its biggest trading partner tightened the screws. Others warned that escalating tensions could backfire, potentially hurting Canadian businesses and workers. But one thing was clear: Canada was not going to take this lightly. Prime Minister Justin Trudeau made it clear: Canada wouldn't take this sitting down. Everything is on the table, he warned, calling for a united front. Meanwhile, Ontario Premier Doug Ford took it a step further, floating the idea of banning American liquor imports and even cutting energy exports to states like Michigan and New York. Now here's where things get tricky. The US and Canadian economies are like tangled wires. Pull one, and the whole system could short circuit. A huge chunk of American refineries, especially in the Midwest and Rocky Mountains, rely on heavy crude from Canada. If Canada were to tighten its oil supply, gas prices in the US could skyrocket. And back in Canada, oil-rich provinces could take a serious economic hit. But that's not the only energy drama unfolding. Over in Asia, China has been making major shifts in its oil game. US crude exports to China have taken a nosedive, dropping from 150.6 million barrels last year to just 81.9 million barrels. Why? A mix of factors. China's slowing economy, a push for renewable energy, and a growing preference for oil from Russia and Iran. And Beijing isn't just walking away quietly. In direct response to US tariffs, China fired back with its own set of penalties, hitting American energy products with new taxes. Starting February 10, 2025, US crude oil will face a 10% tariff, while liquefied natural gas, LNG, and coal will be slapped with a 15% tariff. This shift marks a huge turning point in global energy politics. Once the second largest buyer of US oil, China has now tumbled down to 6th place. That's not just a small shuffle, it's a major realignment that could reshape the way oil flows around the world. For years, China has been the world's top oil importer, pulling in millions of barrels daily to fuel its massive economy. But things are shifting. Recent reports show that China's overall crude imports have actually dipped by about 7.2% compared to last year. Why? A mix of factors: lingering effects from COVID-19 lockdowns, well-stocked domestic reserves, and plans to upgrade refineries. But here's the twist. Even with this drop, China has been quietly reshaping its buying strategy to get better deals and more control over its energy supply. Government customs data suggests a noticeable shift in who China is buying from. Instead of relying as much on traditional Western suppliers, Beijing is leaning more toward cheaper and politically isolated sources like Russia, Iran, and Venezuela. And the numbers back it up. According to energy tracking firms like Kepler, China's imports from these sanctioned nations are creeping up. A 2% increase in shipments from Iran, for example, might sound small, but when you're importing over 10 million barrels a day, that's a massive amount of oil. So why the shift? Simple: money and strategy. Ever since Russia was hit with Western sanctions, it's been offloading oil at steep discounts. China, always looking for a bargain, has taken full advantage, snatching up Russian Urals crude at prices well below market rates. Iran, facing US sanctions, has also found a way to keep its oil flowing to China, just not in a traditional way. Instead of shipping oil directly, Iranian tankers often switch off their tracking systems, transfer crude to other ships at sea, especially near Malaysia, and then continue their journey under a different identity. By the time the oil reaches China, it's labeled as coming from a different country, sometimes Malaysia, sometimes Oman. Venezuela, which has been under heavy US sanctions for years, plays a similar game. Even with restrictions in place, its oil still finds a way into China through complex payment systems and third-party traders. And since Venezuelan crude is often much cheaper than other sources, smaller Chinese refineries, especially those outside government control, are more than happy to buy it. China's energy strategy isn't just about getting cheap oil. it's about long-term security. By spreading its purchases across multiple suppliers, including those outside the influence of the US and Europe, China reduces the risk of relying too much on any single country. And there's another bonus: buying oil at a discount allows Chinese refiners to operate with higher profit margins. That means they can either sell fuel at lower prices domestically or flood the market with cheap refined products, especially in Asia, further strengthening their economic grip in the region. Tracking these secretive oil trades isn't easy, but analysts have ways of uncovering what's really going on. Companies like Kepler and Vortexa use satellite images, ship tracking data, and port records to follow oil tankers in real time. One common trick: some tankers disappear from radar by turning off their tracking systems, something known as going dark. Others conduct ship-to-ship transfers in the middle of the ocean to disguise where the oil originally came from. Ports in Malaysia and Oman have become hotspots for these transactions, allowing Iranian and Venezuelan crude to be relabeled before heading to China. Even though Chinese customs records might not officially show these barrels coming from sanctioned countries, the spike in shipments tells a different story. It's clear that China is deliberately tapping into these cheaper sources, saving billions of dollars and reshaping global oil flows in the process. China's growing appetite for bargain oil isn't just affecting its own economy, it's sending ripples across the entire global energy market. Traditional suppliers like Saudi Arabia, Angola, and Brazil are feeling the pressure, sometimes even adjusting their official price structures just to stay competitive. This new reality has forced major oil producers to rethink their pricing strategies. With China securing deeply discounted shipments from sanctioned nations like Russia, Iran, and Venezuela, Western efforts to curb these oil flows are being put to the test. And as China continues to prioritize affordability over traditional partnerships, it's starting to play a bigger role in shaping global oil prices. For Russia, China's shifting oil priorities have been both a challenge and an opportunity. After facing waves of sanctions following its invasion of Ukraine, Russia turned its focus toward Asia, particularly China. This move wasn't just about survival, it was a complete overhaul of its energy strategy. By offering steep discounts on its crude, Russia quickly became one of China's go-to suppliers. In 2023 alone, trade between the two nations soared past $240 billion, with oil and gas making up a huge chunk of that figure. But Russia didn't stop there. In 2024, China completed the Power of Siberia pipeline, giving it a direct line to Russian natural gas. And now, discussions are underway to expand those supplies through the proposed Power of Siberia 2 pipeline, which would redirect gas that was originally meant for Europe. This shift has fundamentally altered global energy flows, with Russia becoming increasingly dependent on China to absorb its exports. And for Beijing, securing a long-term energy supply from Russia helps reduce its reliance on Western-controlled markets. China's energy strategy isn't just about getting the best price, it's also about building alliances that serve its long-term interests. And nowhere is that more evident than in its dealings with Iran. Despite US sanctions aimed at cutting off Tehran's oil revenue, China has remained a steady buyer, often purchasing Iranian crude at rock-bottom prices. These deals don't just provide China with cheap energy, they also serve as a financial lifeline for Iran, helping it fund key government programs, including military initiatives. Washington hasn't turned a blind eye to this. In October 2024, the US rolled out even tougher sanctions targeting Iran's oil and petrochemical industries, hoping to squeeze Tehran's economy. But so far, China hasn't backed down. Instead, it's continuing to find ways to quietly bring in Iranian oil, sometimes by disguising shipments or routing them through third parties. While China's oil trade with Russia and Iran grabs headlines, its energy relationship with the United Arab Emirates, UAE, has also been growing at a rapid pace. By 2023, trade between China and the UAE had skyrocketed to nearly $95 billion, with non-oil goods making up $83 billion of that total. But energy still remains at the heart of their relationship. The UAE's natural gas exports to China reached over $4 billion that year, reinforcing Beijing's strategy of diversifying its energy sources. And it's not just about buying and selling oil. Under China's Belt and Road Initiative, state-owned China National Petroleum Corporation, CNPC, has deepened its partnership with the Abu Dhabi National Oil Company, ADNOC. These joint ventures aren't just about securing more oil, they're about embedding China more deeply into the global energy system. In mid-2024, China's state-owned energy giant, CNOOC, struck a major deal with the Abu Dhabi National Oil Company, ADNOC. The partnership focuses on exploring new oil and gas reserves, ramping up production, and expanding the trade of crude oil and liquefied natural gas, LNG. This agreement isn't just about business. It reflects both nations' desire to strengthen their energy ties for the long haul. But it's not just fossil fuels that are on their radar. Both China and the UAE have been pushing for a greener future, pouring investments into renewable energy. China, already a leader in solar technology, has been exporting massive amounts of solar panels to the Middle East, helping the UAE reach its clean energy targets. Economic ties between the two countries are also tightening. China has been the UAE's top trading partner for years, while the UAE has become China's second-largest commercial ally in the Middle East. Investments are booming on both sides. Chinese investments in the UAE surged by 16% last year, topping $1.3 billion, while UAE investments in China skyrocketed by 120%, making up nearly 90% of all Arab capital flowing into China. China's growing partnerships with Russia and Iran could have a major impact on its demand for American energy. With access to cheaper oil from these politically isolated suppliers, China has fewer reasons to buy from the US. And it's not just about price. This shift is also part of a broader strategy to reduce dependence on Western-controlled markets. Beyond oil, China's relationship with Russia and Iran extends into diplomacy and trade. These ties align with China's broader Belt and Road Initiative, a global infrastructure project designed to expand Beijing's influence across multiple continents. Strengthening energy ties with nations outside Western influence is just another step in securing its economic independence. If China continues to scale back its oil imports from the US, it could have ripple effects across the American energy sector. Lower demand means downward pressure on crude prices, potentially cutting profits for US oil producers. That, in turn, could slow down investment, affect job creation, and even alter long-term economic projections for the industry. At the same time, the ongoing trade disputes between the US and China have only pushed Beijing to seek alternatives. With tariffs and trade restrictions making American energy less attractive, China has been steadily reducing its reliance on US oil. This shift doesn't just impact oil companies. It could also widen the US trade deficit and affect key economic indicators. China's journey as the world's top oil importer reflects the country's rapid industrialization and ever-changing energy strategies. With daily crude imports exceeding 10 million barrels, China has long shaped global oil demand. But as it diversifies its sources, secures cheaper alternatives, and invests in renewable energy, the balance of power in global energy markets is shifting. In the early 1990s, China hit a major turning point in its energy history. After decades of being self-sufficient, the country found itself consuming more oil than it could produce. By 1993, domestic fields like Daxing simply couldn't keep up with the country's booming industries, and for the first time, China had to start importing oil to meet demand. At first, it turned to nearby suppliers in Southeast Asia, but that was just the beginning. As China's economy exploded in the 2000s, fueled by its entry into the World Trade Organization, WTO, and massive investments in manufacturing and infrastructure, oil imports skyrocketed. By the end of the decade, China was bringing in over 4 million barrels of crude every single day. To handle this surge, China rapidly expanded its pipeline networks and refining capacity, making sure it could process even larger volumes of crude, and it paid off. By 2017, China overtook the United States as the world's #1 oil importer. Instead of depending mostly on the Middle East, it began diversifying, ramping up purchases from Russia and Africa. By the late 2010s, China was importing nearly 10 million barrels of oil daily, cementing its dominance in global energy markets. Even when COVID-19 upended global supply chains in 2020, China didn't hit the brakes. Taking advantage of crashing oil prices, it built up massive reserves, ensuring a steady supply. By 2023, as its economy bounced back, China was importing a record 11.3 million barrels per day. China's approach to energy isn't just about securing enough oil, it's about playing the long game. And that means rethinking who it buys from. Instead of relying on US crude, China has been shifting its focus toward its BRICS allies, particularly Russia and Iran. This isn't just about finding cheaper oil, it's a strategic move to reduce dependence on American-controlled markets. Western sanctions on Russia following the Ukraine conflict opened up a new opportunity for China: access to Russian oil at steep discounts. At the same time, Iran, long under US embargoes, offered China an alternative supply source, further diversifying its energy imports. By cutting back on US oil, China is doing more than just saving money. It's also insulating itself from trade pressures and potential sanctions. And there's another twist. Many of these oil deals are now being conducted in non-dollar currencies, challenging the long-standing dominance of the petrodollar system. China's retreat from US crude isn't just an economic shift, it's a geopolitical power move. If China keeps scaling back its American oil purchases, it could lead to a supply glut in the US market. That might sound like a good thing for consumers, but for producers, it's a different story. Lower demand could push prices down, shrinking profit margins, discouraging new investments, and even cutting jobs across the oil sector. And that's just the beginning. By strengthening energy ties with BRICS countries, China is helping build an economic bloc that operates outside of US influence. That could weaken Washington's leverage in global energy markets and reduce the effectiveness of sanctions as a political tool. There's also the looming risk to the US trade balance. With petroleum being a major export to China, a continued decline in purchases could widen the trade deficit, putting further strain on an already tense economic relationship between the two superpowers.